Ever wonder how some investment funds just seem to crush it year after year? Well, today we're pulling back the curtain on one of them. In this explainer, we're going to break down exactly how the hedge fund Seven Corners Capital is getting these incredible results. Okay, let's dive right in.
So first things first, let's just look at the raw numbers for this year. The S&P 500 is up 11% year to date, which is a really solid return. But then you look at Seven Corners Capital. They're up a whopping 27%. That is more than double the market's performance. So how on earth are they doing it?
And get this, it's not like this is just some recent hot streak. If we zoom out and look back to the start of 2020, the story gets even crazier. The S&P 500 has had a fantastic run, up 119%. But Seven Corners, they're sitting on a staggering 199% return over that exact same time. Yeah, that's not luck. That's a strategy.
So, what is this magic strategy? Well, the how behind these numbers all comes down to a super focused, really concentrated approach.
Okay, so the heart of their whole philosophy is what's called high conviction investing. And look, this is not your typical diversify across 500 stocks playbook. No, it's the exact opposite. It's all about making huge, focused bets on just a handful of companies. Companies they believe are either seriously undervalued or have some kind of special situation brewing that could unlock massive, massive growth.
And when we say concentrated, we mean concentrated. Just look at this, only 3 companies, Pershing Square, Turning Point Brands, and Genworth, make up almost 60% of their entire portfolio. I mean, that is the definition of putting your money where your mouth is. So let's dig in and see why these bets paid off so big.
All right, so let's break these top holdings down one by one. Because really, understanding the story behind each stock, that's where this whole strategy just comes alive.
First up, their number 1 holding, taking up a massive 28% of the portfolio, Pershing Square Holdings. Now check this out. They got in at just $15.75 a share. Today, it's trading around $57.50. That is a jaw-dropping 265% gain on their single biggest bet. So you gotta ask, what did they see that nobody else did?
The thinking here is really interesting. First off, it was a pure bet on the legendary manager Bill Ackman. They trusted his skill. Second, the stock was trading at a huge 34% discount to what it's actually worth, a gap they were convinced would eventually close. And the real kicker, the potential catalyst, a strategic shift that could turn Pershing into a holding company, kind of like Warren Buffett's Berkshire Hathaway.
All right, next up, their number 2 position, Turning Point Brands. This one's 16% of their portfolio, and guess what? It's another absolute home run. They paid around $25.60, and it's now trading near $98.50. You do the math, that's a gain of roughly 285%. So what's the story with this one?
So a lot of the growth is coming from these really iconic brands, right? You've got Zigzag and Stoker's. They also have a new joint venture with Tucker Carlson. But here's that special situation angle again. There's a potential catalyst on the horizon. Activist investors are pushing for the company to split up its different business segments, a move that could unlock a ton of hidden value for shareholders. And rounding out their top 3 is Genworth Financial, at 14% of the fund. Again, look at these numbers. They got in for just $3.75. It's now at $8.40. That's a solid 124% gain. And this is a classic special situation play.
Okay, so you have to wrap your head around this, because it's the whole thesis. The entire company, Genworth, was trading for less than the value of just one of its assets. See, it owns an 81% stake in another really profitable company, Enact Holdings. And that stake, just that piece alone, was worth more than Genworth's entire market cap. So the catalyst they're betting on is a potential split, separating the good, profitable stuff from the old legacy insurance business. If that happens, the market would be forced to see its true value.
But hey, it's not all just deep value plays. Seven Corners also makes some serious bets on growth. Take Instacart, an 8% position. That's up over 50%. And the bet there is on its really resilient flywheel business model. And then you've got Rocket Companies, a 6% position that's up a huge 118%. That's a bet on a market leader just making smart, transformative acquisitions. And just to round things out, they've also got a 6% position in Sandridge Energy that's doubled, up 100%, and a 5% position in Airbnb. So it just goes to show you, even inside a super concentrated portfolio, they're still finding room to play in different sectors like energy and travel.
So, when you put all these pieces of the puzzle together, you start to see a really clear philosophy emerge. It's not just about what they're buying, it's about how they think.
You can really boil their entire strategy down to 4 core tenets. First, Make big, high-conviction bets. Don't be shy. Second, hunt for value. Find those companies trading for way less than they're actually worth. Third, pinpoint the catalysts. You have to know what event is going to unlock that value. And fourth, and this is probably the hardest part for most people, you have to be patient. You have to be willing to hold on and let your thesis actually play out.
You know, Seven Corners actually uses this quote from Warren Buffett in their own letters, and it just nails that fourth point perfectly. In a market that's all about speed and constant trading, their secret weapon is often just doing nothing, having the discipline to let their best ideas cook.
And what's the result of that whole philosophy? Well, it all comes down to this one huge number, 80%. That's how much they've outperformed the S&P 500 since 2020. I mean, we're talking a full 80 percentage points more. That's the real, tangible result of being patient and focused.
So it kind of leaves you with this one big question to chew on, right? In a world that is just obsessed with constant trading, with always being active, the success of a fund like this really makes you wonder, what's the true value, the hidden value, of just patiently doing nothing at all?